Hi GA students, let's revise advanced capital budgeting of CA final AFM. We'll go through illustration 1, which is a basic one. So I'll not be solving basic questions. I'll just explain what it is. So in this illustration 1, they're asking us to calculate NPV of a project. So going back to Inter, so in Inter we studied this NPV concept, net present value, wherein we'll check the feasibility of a project, whether to accept a project or reject a project. If the NPV is positive, then we can accept a project. If the NPV is negative, then we should not accept the project. So basically, what is this NPV? It's like I'm investing 1 lakh in a project, and the project will give me returns for next 5 years. In the next 5 years, whatever returns I'm getting, I'll discount it with the present values. I'll account for inflation, all those things, and then I'll finally see whether I'm profitable on that project or not. So NPV will give me the estimation. So in this question, illustration 1, the initial outflow of project is 40,000, which signifies we have to invest 40,000 in that project, and annual cash flows from the project without inflation is 15,000. They've given direct cash flows. In some questions they'll give revenue and then cost separately. In those cases, we have to a tax percentage also they'll give, so we have to see the savings on tax on depreciation. In this question, they've given direct annual cash flow, so we don't need to worry about those things, but the cash flows are without inflation. We'll see what it is. And then they've given useful life of the project is 4 years, cost of capital is 12%, which we will use to discount the annual cash flows. In this case, they have mentioned inflation premium of 10%, which is included in the cost of capital. In this question, if we notice something, that the annual cash flows are without inflation, but the cost of capital is with inflation. So we cannot discount a cash flow which is without inflation with the inflated cost of capital. So there are two approaches here. One is either restate the cash flow in nominal terms and discount at 12%, like we will apply inflation on the cash flows, then it is comparable with the cost of capital. Or we will discount, we will make the discount rate in real terms and then discount with the real cash flows. So we'll first go with the approach 1, wherein they've given the real cash flows 15,000 for all 4 years. There is no yearly cash flows given here. 15,000 is all for all the 4 years. So first year, they've given inflation premium of 10%. So first year we'll multiply with 10%, or ideally add 10% to 15,000, which is coming up to 16,500. Then 16,500 into 1.1, or 15,000 into 1.1 square. So which is coming up to 18,150, then 19,965, then 21,962. In this case, we can then we have to discount it with our 12%, which is inflated cash flows. So they have done the same thing, and finally reducing our initial cash flow, so which is giving us 17,369 approximately, which is positive, so we can accept the project. In the second approach, we'll restate the discount rate in real terms. So we'll take 12%, then divided by the 10% minus 1 to get our real discount rate, which is coming up to 1.8%. In the second case, we'll not inflate the cash flows as we are restating the cost of capital. So 15,000 will be a real cash flow. Then the restated discount rate was 1.8%, and then again we'll get the same answer, 17,367. In either case, it's same only, so we can accept the project. Thank you.